Yes. This is Your Money, Your Call.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open right now on 1300 30 34 35, or of course you can also email us on yourmoney@skynews.com.au. And joining me on the panel tonight we have Mathan Simasundram from Blue Ocean Equities and also Michael Wayne from Magellan Financial. Well, the market reaching another fresh 10-year high. Can anything stop it at the moment? We're seeing a great run, not only for the US stock market, but for the Australian share market as well. So let's ask our panellists what they see for the market in the first quarter of 2018. Mathan, I'll start off with you. There really seems to be a focus on global growth, synchronized global growth, and I guess we're going to hear that again and again. But commodities have been doing extremely well. Can this run keep up?
Everything is running. Bond yields are running, commodities are running, Aussie dollar is running, the market's running. Even if you get bad data like we had with non-farm payrolls, it was a substantially weak data, it doesn't seem to worry the market at all. So at this point, you know, it's like saying don't stand in front of a train. It's running, you go with it. I think the real risk would be looking at the reporting cycle coming up for both US and Aussie market in the next couple of months. But given that there is a lot of one-offs being played out, especially in the US, I think it'll keep going. So I think Q1 looks pretty positive, and I think you probably will see this running into Q2 as well.
Okay, and I guess, Michael, looking at the market, is it just a case of the Australian market being lifted by what's happening in the US, or are we expecting more optimistic earnings growth from the Australian market?
Look, we are seeing earning revisions higher, really across the globe, but particularly I think in Australia, what's driving the market at the moment is really the materials. We're seeing sort of BHP back above $30. Rio Tinto's had an incredible run as well. So those cyclical commodity companies that have had a good couple of years now, they're starting to sort of kick on and even make higher ground, and we can expect potentially even further upgrades as many analysts start to plug in these higher commodity prices into their models. So I, like Mathan, I think that the February reporting season, the half-yearly reporting season, will be a real big catalyst. If we can get through that unscathed and deliver results at least in line with some of these revised expectations, then there's no reason why this market can't continue. But as always, you need to be cautious, and the sectors that performed well last year won't necessarily do well again this year. So you've got to be careful of any rotation that might take place out of, say, some of those yield proxies into more cyclicals and etc.
Okay, and I guess, Mathan, that's one of the things that the market's betting on at the moment. The research houses, when they do come back from holidays, that they'll have a look at the spot commodity prices and we'll be in for some more positive revisions. You're already seeing BHP at 2.5-year highs, Rio Tinto at 6-year highs. You know, how big can those revisions be from the current share prices?
Oh, I think they've been wrong for a very long time, so there's a big upgrade cycle coming. I mean, I spent a good part of 20 years working in the big banks, so the whole cycle is all the macro guys will sit at the end of each quarter and reassess. I would say good part of 80-90% of the big brokers have been left behind as far as where the spot prices are on commodities. So there's a decent amount of upgrade going. I don't think anybody would be having the iron ore prices currently or the oil prices. So in that context, you will see upgrades coming through. And, you know, you've seen balance sheets improve, you've seen capex grow, you've seen high commodity prices. BHP and Rio, you know, and pretty much all the miners, it'll be hard for them to go wrong in the results season.
Okay, so putting you both on the spot, favourite resource stocks, Michael?
Look, I'm typically fairly cautious on resources, but I've certainly been sort of caught out by the size of the rally that we've seen and how aggressive it's been. BHP's been our go-to probably since the low 20s just because of that diversification. Galaxy Resources for some more speculative clients. That's obviously a play on the lithium space and the batteries and those sorts of things. So at this point, probably just ride some of the bigger players, Rio or BHP. But over the medium to longer run, you need to understand that commodities are very cyclical. So you've got to take the good with the bad and be quite nimble through this.
Okay, so being quite nimble, any favourite resource companies, mate?
Oh, look, I like the lithium stocks. I think they've still got time to play out. I think if you wanted to get a bit of the global growth in play, you look at copper stocks. Metalex is an interesting one for me, which has a bit of a lithium play as well. I think FMG looks oversold on iron ore, given where the iron ore spot prices is. But I actually would say, if you're looking at the resource sector, look at the next derivative. Look at the services companies, because there are a number of service companies who haven't started their upgrade cycle yet. and that'll play out well for them. So one of my favorites is Austin Engineering, and it's doubled from around 14 cents to now it's about 30 cents, just short of 30 cents, and I think there's a lot more upside to come on that.
And Michael, I see you nodding your head there. We saw mining services companies really start to come out with a bit more positivity last February. Is it going to continue?
Well, Nathan's been big on this for a while. That's sort of why I'm nodding my head. And now, even now, I've started to sort of come around to the idea. Many of these things have been beaten up significantly, but although we've seen commodity prices come back, slowly some money's starting to drip into that end of the mining services space. I mean, people still are terrorised by memories of things like Forge and Borat Longyear and so on and so forth, and that will take a bit of time to clear in people's psyche, but I think you're starting to see that. And the longer the commodity prices can be sustained at these levels, particularly those sort of mining services that are required in a steady state operation as opposed to an exploration phase, I think they can continue to do well. But again, you have to understand this is a very sort of volatile and very turbulent end of the market, so it just does depend on the individual.
Okay, and so much of global growth has been powered along by the US. So do you go those US-centric stories, things like BlueScope Steel, the James Hardys of the world, or do you look more domestically?
No, I would be looking domestically. I think there's a lot more risk. If you look at the consensus forecast on economic growth locally, about the last, well, I suppose the next couple of years, most analysts have started to downgrade. So we're actually seeing the dip that most people were forecasting in 2019 actually come back to 2%. So there's a slowdown potential risk, and the market is beginning to price that in the local economy. I think the US economy is doing okay. I think that started, I think it's about the start of 2015. So, you can always play, everyone talks about the politics of it, but the global growth started at 2015. You've had that cycle running through, and I'd expect that to run through at least for another year. Now, the trick would be, will it continue and will it be the driver? I think the one driver that nobody's looking at is how quickly US dollar has fallen against most other currencies. And the biggest driver there is that the market is moving from US to Europe, because you're getting better growth at a lower multiple with more accommodating monetary policy. So in that context, I think that'll keep playing out. So US dollar will continue to weaken, and while that happens, you're going to see better commodity prices and better for emerging markets.
Okay, so like in Europe, any part of the globe that's a favourite for you?
Europe is considered to be where the US was maybe 2 years ago, and that's why you're seeing a lot of those fund flows move into Europe, particularly things like European banks, for instance, have been very popular, and I don't see any reason why that can't continue, but often when something looks so obvious, something else sort of shifts in the global landscape. I think even China still looks fairly good, although their headline growth figures are slowing. The consumer strength over in China appears to be quite good. The private sector remains in fairly good shape. A lot of the debt, although it is increasing, a lot of it is held by state-owned enterprises. So I think Europe and China are the obvious sort of picks there. The US, I think you can still find growth, particularly maybe in sort of the Russell 2000, some of those more domestic orientated businesses as that US dollar comes down. That could be an option. So yeah, it just really does depend.
Okay, we do have our first caller on the line, so let's go straight to Lisa from the Gold Coast. Lisa, welcome to the show. Great to hear from you. What's your question for our panel tonight?
Oh, hi Julia and hi fellas. Just wondering, I have APA Group, and just been going a little bit down lately, and was wondering if you think that it might be time to sell or to hold that. And also on Mantra, can you just tell me what's going on with Mantra? I know that nobody's sort of been mentioning it lately, and any views on that? Thank you.
Sure. So a couple of questions coming through from Lisa. The first one on APA Group and the second one on Mantra Group. Mantra Group, of course, under a takeover bid, and that's probably why you haven't heard too much around Mantra. There's been no other bidders coming through. So I guess the market probably betting that that one's going to go through the keeper. But APA Group, an interesting one that has outperformed since the global financial crisis. But lately we haven't seen too much happening. If anything, the shares have been taking a bit of a step back. Look, in terms of their guidance, they're expecting to see FY18 growth of between flat to about 3%, so nothing too impressive there. And of course, with interest rates about to go up once again over in the US in 2018, is this a stock you want to hold in your core portfolio? Michael, what do you think? think of APA?
We sort of touched upon this in the opening, this whole sector rotation that you might want to be worried of going into 2018, particularly many of these high yielding type businesses that are ex-growth. They're probably going to come under a bit of pressure as interest rates, not only in the US but globally, move higher. You'll see a rotation out of these names into sort of more cyclical names. So APA was wonderful when interest rates were going down. Now that interest rates are going up, potentially even quicker than people were expecting, considering these tax cuts coming through and some of the growth that we're seeing coming out of the US, companies like APA, you can probably extend this bow to things like Sydney Airport, Transurban, some of your real estate investment trusts. You've probably seen a little bit of weakness across the board in most of those names.
Absolutely. I mean, just having a look at APA and how it's performed, you know, you don't really expect to see a company like this increasing by 20-30% because it's a regulated industry. But does it have a part to play in people's portfolio? Would you be holding it at the moment, Nathan?
Oh, look, I think it depends on your portfolio and it depends on what your expectations are on returns. It's a solid returning stock, but the problem is, as Michael said, it's basically a yield play. So when interest rates go up, these things go down. I mean, they're basically just a massive leverage play. So they have huge interest expense. Interest rates goes up, cost of running the business goes up. They're not going to make as much, but they're pretty regulated industries. They tend to hold up relatively okay. As a part of a portfolio, it makes sense. Would I be picking that as a stock to be active on? Definitely not in this cycle. The other thing to remember is if you look at what potentially could happen is potentially this is a cycle in the bigger cycle. So interest rates are going to go up. I mean, that's set now. But the problem is Fed might slow down the rate cycle, and that might be positive. So you might get a period where these guys will outperform. But if I had to pick out of the utilities, infrastructure stocks, and other yield options, I'd probably go to someone like an infrastructure stock simply because it's a bit more leveraged to the economy. So more people are on the roads, more people travel through the airport. It's a bit more defensive. And I mean, if you've been to the Sydney airports, you realize how much they take money off you everywhere. So they find new ways to get revenue. So in that context, they tend to be a bit more growthy for a low growth sector, so I'd probably lean there.
Just on APA, just quickly as well, just aside from the interest rates, they've basically become a monopoly through a lot of acquisitions, and that's how they've grown in recent years. There's a big question mark as to whether the regulator is going to continue to allow them just to keep acquiring these pipelines because they're basically a sole operator in that space. So that's another thing that might stunt their growth going forward.
Okay, so an interesting one, APA in that energy infrastructure area. The other one's Mantra Group. We've seen that takeover bid come through from the French group Accor at $3.96, I think it was. The shares of Mantra last trading at $3.91. No one's really expecting a counter bid or anything, are they?
Look, in the tourism sector, it's actually been one of the worst performers, despite every macro factor actually backing it. But again, you haven't actually made a lot of money in the tourism sector, even though it was the obvious trend. If you look at the data coming out of Sydney Airport, you would have thought that sector would be killing it. Probably Sea-Link is the best one. So if you want to get same kind of exposure, the one that's doing well is Sea-Link, and I expect that to continue to do well.
Okay, I mean, you look at those international travel numbers and they're just blowing things out of the water. We're seeing visitors over from China, from Asia, from the US, and that they're all coming through our airports. But these tourism stocks, they're not doing so well. Do you have any favourites there?
Look, I mean, at one point I sort of was into Mantra, but it was basically the V shape, went all the way down, and then this takeover came through and it sort of jumped back up. Sea-Link was one. Obviously, you've had the sort of Ardent Leisure situation, which has obviously been a negative for that space and that whole industry, really. But that might be a bit of a bargain opportunity for those looking for a bit of a turnaround story. But by and large, I've left that space alone in the last sort of 12, 18 months.
Okay, on that note, we'll be back with more after this short break. If you'd like to speak with our expert panel, now's the time to give us a call. The number's on your screen there, 1300 30 34 35. And of course, you can email us, yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35 and your emails, yourmoney@skynews.com.au. And we now have Tony on the line from Sydney. Tony, welcome to the show. How can we help you out today?
Thank you, Julia and panel. I have a small holding in a speculative micro cap in the biotech space, and it's called Avita Medical. the code for that is AVH.
Sure.
I would be interested in the panel's view of the prospects of the company. I like the story that's being spun by the managing director at the moment. They have a skin repair product in the advanced stages of FDA approval in the States.
Sure.
And if that seems to work, or if that comes through, it would seem to augur well for the company. But I would be interested in the panel's view if they know the company at all. Thank you.
Sure. So an interesting company and an interesting question coming through from Tony, especially given that here in Australia, you know, in the biotech space, we have seen many success stories. I guess the biggest one is CSL, but also Nanosonics in this space has been a huge growth story. Now, Avita's a much smaller company and at a much early stage of its life cycle. It looks at a product called ReCell, which is used to treat second and third degree burns. And I guess their biggest market at the moment would be the potential of the US. So having a look at Avita shares or any other biotechs that might seem interesting to our panel. Nathan, what are your thoughts here?
Look, biotechs, you've got to be careful because they always will tell you a good story because that's what you're buying. You're buying a story. It's pretty much like a mining company. You're drilling and hoping that you find the commodity. These guys are going for the big thing. Now, with skin treatments, it's not quite unique. There are a number of different players in this space. There's one actually listed in Australia called Polynova and does pretty similar thing. The biggest problem is, I mean, they're phenomenally effective and they do such a great job, but it's your customer base. So you've got to understand, it's one thing to cure a particular problem, but it's another thing to know that whether they're going to make a lot of money doing that, because their customer base that require that product, it's not like you're trying to cure cancer or you're trying to cure flu, because you know there's a big customer base. When it comes to skin, when it comes to damaged skin and you're trying to cure that, there's only a limited amount of customers. Are they willing to pay a high price? Probably not. And this is where your margins play into it. So if you look at how much the total market is, how much of that these guys will win, that will tell you where the upside is. So you do take on a fair amount of risk in a biotech stock because they have to go through a number of stages of testing. And if the in an eventual marketplace is a limited one, it's not worth the risk return for me.
Look, it's a really interesting point that Nathan brings up, because this product has been available for commercial use for, I think, the last decade, and you haven't seen a massive take-up around the globe. Now, the US is a big market, and I guess a lot of it is around take-up, and because this isn't for minor burns that you use at home, but more in a hospital setting, it's more around doctors and hospitals taking up this type of product.
Yeah.
What's your view in terms of
That's what basically Nathan's sort of touching on. A lot of the success of these products isn't whether they work or not, it's the commercialisation of it. And when it comes to healthcare, particularly in sort of a clinic environment or hospital environment, a lot of it is a sales team and your sales drive that you have behind. I mean, one that's got a lot of coverage over the last few years is Certex Medical. They have a certain procedure that helps extend cancer, the life of cancer sufferers by a certain amount of time. However, many doctors are very conservative by nature. They would rather stick to the tried and tested method of dealing with many of these things, and it takes a long time to convince them and a lot of proof to convince them that it's worth adopting these new technologies. So that's probably the situation you have with this company. I must admit it's not one I'm too familiar with at all, given it's fairly small. I tend to focus on sort of larger businesses, but biotechs by nature should only take up a small portion of your portfolio, because really you've got to go through so many different stages. Often there's capital raisings along the way to market the product, and then those sorts of things, develop the product. So yeah, look, if you've been listening to the CEO for a while, you've been following the company for a while, you're probably in a much better position to make the decision than me.
Okay.
I mean, a lot of these biotechs, when they get to that stage, as Michael said, they tend to do a deal with one of the big pharmas to take advantage of their distribution network, because they've already greased enough doctors around the world, they can get it to places that you probably want. So the big problem is, even once you got it up and running, then you got to find a deal, and so these things always take a lot longer than what you think.
Okay, so an interesting company, but looking for that distribution network, especially the US, and if they can crack that market, I guess that would be behind the success of a brand like this. Let's go to our next caller. We've got Jeff on the line from Melbourne. Jeff, welcome to the show. How can we help you out tonight?
Thank you for taking my call.
Pleasure.
I'd really like to know about Bubs and Kidman Resources, please.
Sure, two very high growth stocks. Looking at Bubs, BUB is the stock code. The company is involved in baby food, as organic baby food, as well as goat milk formula. And I guess it's a growing segment of the market. Most infant formula is cow milk based. So if you want a goat milk based formula, there's not too many options out there. So here in Australia, they have been increasing their distribution quite aggressively. And of course, there are hopes that aggressive growth expands into Asia as well. So having a look at Bubs Australia, a bit of a newbie on the market. They have also made an acquisition of, I think it was Newlac, which means they're also a vertically integrated producer. Looking at the baby formula space, I mean, you've seen a bit of a volatile ride. You've obviously got your A2 Milks of the world, which are doing really well. Bellamy's, which has been a little bit more volatile. And then you have something like Bubs. It isn't an easy area, as we've seen from Blackmores and Bega and that joint venture, which has been written off now. What do you think of Bubs?
Bubs has caught my eye just purely because that space over the last sort of couple of years has been going fairly crazy. Bubs is a fairly recent listing and it's been a very good performer since it's listed. I think it has been as high as sort of $1.10 at some point there. It's now back around sort of the 70-cent mark. I think it is quite well backed by the Stokes family, I think, here in Australia. And my understanding is there's a couple of Chinese celebrities associated with the business, whether they're on the board or non-executive directors, something like that. And the idea being that they can take it into China and market it quite well. It's a slightly unique offering in that it is goat milk as opposed to cow milk. But that space overall has had an incredible run. There's no reason why it can't continue to grow, but it's just as whether or not those growth rates are going to be enough to satisfy the market given where valuations are.
Okay, and I guess it's a little bit around education of the market as well. I didn't realise, but apparently goat's milk is more easily digestible to more people than cow's milk is.
Yeah, I actually grew up with goat milk, so
okay.
so I actually think it's quite unique. It does actually work quite well, and I think it's quite effective. The problem with Bub for me is it's coming. I mean, if you remember back in time when Bellamy's and A2 Milk and all of them ran, it was they were in the right place doing the right thing, and it's all about timing. Just as they move into China changed the policy from one-child to two-child policy, and they allowed a lot more people to come in, and Chinese local producers had the health issue threat that scared most parents to the living daylights out of them. So in that context, everything worked for them. So they've had such a good run on that. You're not going to get that for the other guys. You're coming into a much mature model with more competitors in. And you're already coming into a sign where Europeans are actually increasing milk production substantially. So there'll be a lot more players coming in. And China is a highly regulated industry that can move around quite a bit. Just recently, they knocked off, I think it's about 500 brands out of the milk powder space. So they can move on anything very quickly, so you are taking on a fair bit of risk. Bub has a brand, but doesn't have the distribution network. What the other guys have. Someone else that plays in that space, Wattle, has the distribution network, doesn't have the brand. So all of these guys are trying to get all the pieces together. I think you're better off at this point of the cycle sticking to the guys who are proven. A2 Milk is the one that's still on an upgrade. Minute A2 Milk has one downgrade, you want to get out, but at this point that still looks probably the best place to be.
Okay, so interesting company, Bubs Australia. It has been around for 11 years, even though it has only been trading on the Australian market for a very short period of time. But the goat's milk product only launching, I think, in 2015. We do need to go to a break, so we'll be talking about Kidman Resources when we come back from the break. And of course, if you'd like to speak with our expert panel, we'd love to hear from you. The number's 1300 30 34 35, or you can email us, yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Australia's Business Channel.
Welcome back to the program. Joining me on the panel tonight, we have Mathan Simasundram from Blue Ocean Equities, and we also have Michael Wayne, and the company is...
Medallion Financial.
Medallion Financial. Tell us a little bit more about Medallion Financial.
Fresh venture. Basically, it's been going for close to 6 months now. So we focus mainly on ASX 300, a lot of sort of self-managed super funds, a lot of high net worth individuals purely equities. We're not financial planners or anything like that, and we primarily focus on the domestic market, although we can facilitate transactions in international markets as well, although it is difficult to sort of have a focus on everything, so we do tend to focus more or less on the ASX.
Okay, so ASX 300. And Nathan, Blue Ocean Equities, you've been there for
we're
half
pretty
a year now?
Yeah, about a year now. Look, we're pretty much the standard mid-sized broker, institutional broking, high net worth, and corporate. So it's an interesting time in the market, I have to say. I think a lot of the larger brokers with all the regulatory changes, it's getting harder and harder. But I think it's making. I think the dynamics in the industry is changing quite a bit at this point, and I don't think everyone knows exactly where things are going to settle. So interesting times, definitely interesting times.
It's always good when the market's rising, though. And of course, if you have a question you'd like answered, our number's 1300 30 34 35, or you can email yourmoney@skynews.com.au. Now, before the break, we were talking about Bubs, and we didn't get a chance to talk about Kidman Resources. So KDR is a stock code. The stock has just been going up and up and up. I think about a year ago, the stock was maybe under 30 cents. Now it's at $2.10. It's just been absolutely phenomenal. Is there more upside here? Would you be buying at these levels, waiting for a pullback? What do you think, Michael?
Look, I know it's starting to get a lot of coverage, but in sort of the mainstream commentators that you sort of hear from time to time on various sort of networks, it's obviously a company that's aligned to that lithium boom that we've been seeing. So we've seen a similar performance, maybe not quite as good as Kidman, from the likes of sort of your Orocobraes and your Galaxies of this world. I'm not too across this particular name. I do think it is more domestic focused. It is a explorer at this stage, I think, and it's looking to make that transition into a producer. But the quality of its ore and the quality of its resources is meant to be significantly high, so relative to many of its peers.
I mean, Nathan, you said you like the lithium story. What about Kidman?
This is probably our preferred pick. There's two things here. One, exactly as Michael said, it does have a phenomenally good asset, and there is a risk. I mean, a lot of the, I suppose, lithium producers, when you look at countries where it's probably not the best, how do I put it, human capital being used. So in that context, there is restrictions potentially could come, regulatory side of things, where a lot of the big producers may avoid those producers. So that might actually be a big positive for lithium producers in Australia. The other main catalyst for Kidman is the fact that they do have a relationship with SQM, which is one of the South American players, and they are probably the most experienced at the production side of it. So lithium, there's a lot of lithium everywhere. So the trick here is not just taking it out, then you have to go through the industrial process of it. And the SQM guys have the experience and the know-how to how to do this. So the fact that they got themselves involved with Kidman was a huge positive tick for the asset, because the quality of the asset they see as something that they could do a lot with. So net, I think they're probably one of the better players. And look, lithium story probably has a few more years left in it, but you know, you got to put things into perspective. The same thing happened with graphite 2-3 years ago. Everyone got excited. This was the answer. You know, you're going to build houses with graphite, and then graphite just fell over because it's still going to take time. And potentially that could happen with lithium. But the reality is China is the big catalyst, and they're moving with renewable cars faster than anyone expected, and that's ramping things up, and that's why lithium is running a lot longer than what people think. So look, it could keep going, and for me, if I had to pick, you pick the ones that are doing well, has a lot of the ticks in the boxes, and Kidman is one of those. So I'm happy to back that.
Okay, so Kidman Resources there. We now have Simon on the line from the Gold Coast. Simon, welcome to the show. What's your question for our panel tonight?
Oh, g'day guys. I've bought some WiseTech and Altium about 6-12 months ago, so they're doing quite well. But I've heard you talk about those two stocks as having very high PE ratios. So do you have a look at any of the smaller cap or micro cap tech stocks? There was one today that had a good write-up in all the papers, D13, Department 13, which got a large investment from a US company. And they make systems that control drones. So there's a high security area. They can control the drone and stop it from flying over the high security area.
Sure.
So that was just one of these microcap tech stocks that I've been looking at, and just wondering if you guys have any thoughts about the smaller cap stocks.
Sure. So having a look at the microcap tech stock, and in particular, Simon mentioning Department 13, which is, I think, a product called Mesmer, which looks at, I guess, counter drone, I guess. So trying to protect your territory against drones. But there's certainly a lot of stocks in this space. Another one that we talk about quite often is Appen in the language space. But a lot of these tech stocks do have high valuations simply because what's been running hard has been the NASDAQ index. So having a look at some ideas in this space. Nathan, what are your thoughts?
Yeah, first of all, look, Altium and WiseTech, great picks. You've killed it. That's if you're looking at quality tech stocks in Australia, and if you wanted to pick the FANG stocks for Australia, those two will be there. And if you're holding them, I'd suggest you hold on to them. I'd expect them to do quite well over the next year and probably year after. So they're probably long-term growth stories in our market that actually have proven their track record. Another one, as Julia said, Appen. That's another one we think will do quite well. It's in the right areas as I suppose the media landscape changes and the data aspect of things change, and the language aspect of all these social media and the I suppose the online media space changes, they'll be another beneficiary. So you've got to think of where the dynamics are changing and put yourself ahead. If you're looking at the drone side of things, there's a stock actually listed in our market called Drone Shield, DRO, and they'll give you a big gun. You point at the drone and knock it down. So there's a lot of technology out there for it. The drone side of things, I wouldn't get overly excited. If you are interested, I think you need to do a bit more on the. I would look at things like, I suppose, involved in the overall dynamics of Internet of Things when everything connects, and people who are doing those kind of, I suppose, services, because it's really hard to pick one specific service or one specific technology, because if that goes wrong, you're kind of left out in the lurch. So someone like Altium, someone like WiseTech, they tend to play in a number of space, so they do quite well. Another one that's probably not so loved is Hansen, and they'll do quite well, and I think that's one of the proven ones as well. If you're looking at outside that, I would look at someone like Big Tin Can, BTH, another one that's involved in a number of pieces, and I think they tend to do well. So look at players who cover a space rather than particular technology, because that kind of gives you that, I suppose, the multiple ponies in this technology space.
Okay, and I guess this is a sector running hot, so plenty of ideas coming through from Nathan. You've got the Yogis, the Get Swifts of the world, you've got the Senators of the world, the Hansons, which are a little bit bigger, Department 13. What do you like in this small cap, micro cap tech
micro
space?
cap can be fairly ambiguous. So let's just say anything sort of around the 500 mil mark. Altium's one I've liked for a while and done incredibly well, although I do think it's starting to look fairly fully valued. Integrated Research is another interesting one. This has been around for years and listed for over a decade, and its balance sheet's as good as any of the very high quality large caps in the market, but it does go unnoticed. They basically provide IT diagnostic services to very large corporations globally. I think 50 out of the top Fortune 500 companies, for instance, the top 10 banks in the world. So that's a nice high quality IT business. There's one recently, Live Tiles, that's had a deal done with Microsoft in the artificial intelligence space. So I think you really want to be looking for a number of key attributes from these IT companies. They've either got to be involved in artificial intelligence, data storage. It's ideal if it's that business to business, whereby they sell them a product and then also get the annuity style revenue coming in the years after as they provide the services to maintain that infrastructure. Then there's things like Technology One, which is another very high quality business that's probably fairly large at the moment. And we've seen a lot of takeovers in Aconex recently, so you can just keep scouring the market. They don't have to be out and out speculative companies. You can actually find a number of these companies that are making some decent money and that do have some decent contracts in place, and they're probably where I'll be focusing my attention. But again, we tend to focus more on the ASX 300, maybe slightly outside of that, so we're not really focused on anything that's too micro cap.
That's awesome. Plenty of ideas coming through from our panellists in the micro cap tech space. We do have our next caller on the line, so let's go to Dave from the Gold Coast. Dave, welcome to the show. How can we help you out tonight?
Hi, Julia. Thanks.
Hi.
I just wanted to ask the panel about Fluence Corporation. They're trading at a 200 mil cap. Major shareholder, 30% shareholder, Ronald Lauder, who is son of Estee Lauder, as a few of you would know. They're in the wastewater treatment and water desalination. Earnings for calendar 17 were US 60 mil. So personally, I think they're extremely undervalued, and I probably think they're going to be one of the biggest gainers in 2018. They've got a backlog of US 100 mil revenue.
So Dave, I'm guessing that you're already a holder of the shares.
I am. I've been holding since they listed 2 years ago, Julia. I'm an IPO holder. So.
Sure.
Yeah.
Okay, so having a look at FLC Fluence Corp. Unfortunately, the share price action hasn't been too great over the past year. The stock's down around about 40%. But Dave's quite positive on the outlook for this company, as he mentioned RSL Corp having a close to a 30% stake in the company. So obviously not a huge amount of liquidity when you're looking at something like this as well. Nathan, when you look at Fluence Corp, what are your thoughts?
Yeah, look, I mean, I don't know the specific company, but I've looked at a number of these companies that have worked in the water purification side of things and infrastructure maintenance and monitoring side of things. Most of those companies haven't actually done well. So they do have their runs, and when people get excited, a lot of Israel technology stocks in this space came in and listed in Australia. And in the early times, people got excited, and most of them, as with everything else, we put a bit of China dust on it. Everyone goes, we're going to move into China and clean up China. And they had really big runs because everyone assumed, I can do one project, I'll do 1,000 projects in China. But they didn't quite pan out, and so then, they fizzled out. And I'm guessing that's potentially what's happened here. Look, if they're earning as much as what the caller is saying, then there is an argument for that to see some support, because if you're earning around 60 odd million and your market cap is 200 million, that's not too bad. You can see recovery if it's early stages of a story. So the market might have just got bored with it, and as Julia said, if there's substantial shareholders holding substantial part of it, then there's not going to be a lot of liquidity, so you're not going to get the fund managers buying in, because it's too hard for them to get out if things go wrong. So it's going to be a retail stock. So in that context, I think if you're a true believer, hold on if you've done your research, but I just suggest a bit of caution, simply because a lot of the stocks in that sector haven't actually delivered.
Okay, looking at sort of wastewater treatment.
I mean, there's been a lot of interest in this space, because looking from a macro perspective, it's expected that water treatment market's going to sort of double in size in the space of 5 years or so. I'm not too familiar with this business at all. I haven't really looked at anything in the space at the moment, purely because there probably hasn't been the momentum there. And often, when there's no interest and there's no share price momentum, it doesn't really matter what is coming out from the business. In this case, I think this company's come out with a couple of decent announcements in the last 6 months, yet it continues to sort of fall away. So there's sometimes an underlying reason that you don't really understand why. And in those cases, often it's better to leave it alone. So that's my position on that.
Okay, so that was Fluence Corp, FLC, the stock code there. Time for an email now. This one from Daniel saying, hi guys, your recommendation for the best performing investment fund, investing in overseas stocks and paying a good dividend. Thanks, Daniel from Sydney. So I guess the international market is where the action has been in 2017. Is it going to continue in 2018? And favourite ways to get exposure? Michael, what do you think?
Look, there's a number of ways to take exposure. You can either take sort of ETF exposure, which gives you a broad exposure to that space. Then you've got the larger Australian, but focused on international investing fund managers, the likes of your Platinum Asset Management, Magellan Financial Group. Platinum has had a somewhat of a return to form throughout sort of 2017. They've probably had some of the better performing funds. There are some smaller alternatives out there as well, things like the Forager, the International Fund. I think Montgomery International Fund also had a fairly good year. It's difficult to sort of point out those that have a fairly high dividend yield. Obviously, international markets don't have the same tax breaks as Australian equity markets do. So often it's lower dividends that you receive for that reason. But there are a number of ones for you to go away and do your research on. There are a lot more coming into the market. It's almost the new vogue space to be launching a international LIC or international fund. So do your research, but my advice is probably look for one with a fairly good track record. And have a good look as to what their sort of top 10 or top 20 holdings are if you can get that much detail, because it'll give you a sense of their strategy and not only the sectors they're investing in, but the geographical locations as well.
Okay, I guess looking at this space, would you be entering into a managed fund or actually buying into the operator of a fund? I mean, looking at Platinum, that's up 46% throughout the last year. Janus Henderson up 22%, more in line with what we've seen from the MSCI index, which was up 20% last year.
Exactly. I mean, I love the fact that there'll be fund managers who run yield funds saying we had a great 5 years. Well, pretty much everything with the yield has gone up. So in context, you have to put it in in context with what's happening in macro. Every man and his dog now has an international fund. So does everyone has a small cap fund. So it tells you how much interest it's in that space. So I'd be cautious following the herd, because when it goes wrong, usually the herd is the one that gets hurt. So I'd be a bit more careful, but Julia just mentioned a number of good quality companies that invest overseas. So you can have the benefit of local tax, freebies like franking credits, and yet have the exposure of the global play without having to take on the currency risk. So I would look at someone like Jamieson Henderson, JHG. It's probably one of the better ones. It's a global player, and it's just an asset play. When you're trying to get global investment, you're just trying to hope that asset prices go up. That's pretty much it. Now, the flip side of that argument is you're coming at the wrong time. The thing about it is you buy these things when the US Fed, the main player, is spreading their balance sheet. They are beginning to shrink their balance sheet, which means interest rates are going to go up, asset prices are going to potentially come back. So is now the good time to go global? Probably not. It's going to get harder and harder from here. For the last 10 years, pretty close to 10 years, it's been an easy ride. We know that looking backwards. So future is going to be a lot harder. I would look at some of the quality players from Australia, because as Michael said, you can take advantage of the tax benefits, at the same time have exposure to the asset prices.
Okay, on that note, we are taking a short break, but we'll be back to answer more of your questions in just a moment. And if you'd like to speak with our expert panel, our number 1300 30 34 35, or you can email us, yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Sky News Business.
Welcome back to the show. It is time for an email, so let's go straight to this one from Stuart. Stuart from Melbourne has sent an email asking, "Hi, can the panel please give me their thoughts on PAB, Patries? I have held this stock since 2009 and have accumulated over the years. Some good things on the horizon, I think." A very interesting company, this particular one, and I guess everyone's looking for the cure for cancer, and this certainly is a company that looks at an antibody-based cure for the treatment of cancer and other diseases. PAB is the stock code there. Of course, over a long period of time, you've seen not too much happening, but just recently we saw a jump up in September. Do either of you have you had a look at this space, or any thoughts on this one?
I've looked at biotechs for a long time. The one thing to remember is they need a lot of capital. So they go through stages where they have to do a lot of phase testing for individual treatment and potential treatment. And when they get to probably the second stage, then they try and do a deal with one of the big global pharmas. But the biggest problem for them is they need a lot of money, a lot of capital to get to each stage. So there will be a lot of cap raising through the cycle. There'll be a lot of dilution. So you've got to be a true believer, and obviously you are, because you've been there for a very long time. But look, this is the cycle. I mean, I don't know the individual stock, but if you've done your research, just be aware that they will raise money on a consistent basis to take things further. So you will get diluted. So if you see some negative sentiment come through in the stock, I think it's better to cut your losses.
I mean, they're looking at early stage clinical work from 2019, so extremely early in the cycle for a biotech. Initial thoughts around this one?
Look, you've been in it for almost sort of 10 years or so. You've been continually adding to it. I would be careful just to ensure that it doesn't become a too big a weight in your portfolio. It's okay to have these sorts of things in your portfolio, but you need to always balance the risks. The reward for this company, if it was to be rewarded down the track, is still some way off, and they're just going to continually lose money year after year after year. They're going to be paying management and they're going to be paying staff, and what that means is every couple of years they're going to run out of cash and they're going to have to come back to the market and do a capital raising. So they're going to keep tapping you. One day something might come out, but that is probably the less likely outcome. If you look back through history, the number of biotechs that have been there listed on the ASX, for every 10 that don't make it, there's maybe one that does, and that's probably being generous. So just keep that in mind. Often a good way to play these sorts of things is build yourself maybe a mini portfolio if you like. Go and find your 5 favourite micro-speculative biotechs, and then maybe put a small amount into each of those, and that way you build yourself a mini portfolio within your greater investment. But with these sorts of things, I wouldn't pin your hopes to it, and I certainly wouldn't bet the house on it. Just be very careful going forward and continually stumping up cash.
Okay, so PAB is the stock code there. Very small company. It's only a $17 million market cap. Your Money, Your Call is going to continue after the break, so please keep phoning in if you have any questions, and you can also email us, but we'll be back in a couple of minutes for another hour of power.
You're watching Sky News Business, Australia's business channel.
Hello and welcome to the second hour of Your Money, Your Call. I'm Julia Lee from Bell Direct, and if you have a question about shares, our phone lines are open right now on 1300 30 34 35, or you can also email us yourmoney@skynews.com.au. And on the panel with me tonight we have Mathan Somasundram from Blue Ocean Equities and also Michael Wayne from Magellan Financial. Well, before the break, we were taking some emails, and we've got an interesting one here from a viewer, Mark from Sydney, who asks, "Hi, do you have any thoughts on AU Make? I do have a small holding. They only floated in October and have had a good run, but have come back from 70 cents down to 53 cents. AU Make. AU8 is the stock code. Mathan, do you know this company?
Yeah, it's basically a business that's there to play the middleman between the Chinese Daigou businesses and the Aussie producers. It was I suppose perfect timing when China was becoming a huge retail market. We had producers who were trying to find space. Daigou market became big, especially with the baby milk powder story.
Explain a little bit about the Daigou market for our viewers.
Basically, if you're looking at, for argument's sake, a baby milk powder, you're buying it here for $25. In China, because of what happened with the regulations as well as the local producer standards, I suppose, that scared the parents, they're selling baby milk powder there at $70, $80. So the Daigou's businesses basically buy it here, and they buy Australian-made, Australian products, and they will sell it there, and they make the margin. So it's basic, I suppose, arbitration, and it's pretty simple model, and it's worked really well. But the only problem is you do have regulatory risk in that China is trying to clean up a lot of these middle businesses that do not go through the standard process. So Daigou businesses are being challenged. So that's one worry. The other one is obviously a lot of producers now sell online directly into China. So they can bypass that to a certain extent. So over time that business will struggle. But look, if you invested in this stock, I probably wouldn't have, but I think it listed at 20 cents and ran up to 80 cents. So you've done really well. Even if it falls back to 50 cents, you've more than doubled your money. But in the long term, I think there's just a bit too much risk. I wouldn't be, I'd look at particular product or particular brand that has more stickiness than a particular part of the retail chain, because that can always change with regulation.
I mean, just having a look at their last presentation, and they talk about, trying to cater for the Chinese tourists. So when the Chinese tourist comes to Australia, hopefully they'll visit one of the AU Make stores and buy the products they need: baby formula, vitamins, honey. What do you think of that model? That you could just go to Coles.
Exactly,
Always.
and trust me, when I go to my local Woolies or Coles, I do see a fair amount of that playing out. So, and that's fine. And look, at the end of the day, for Australian producers, the retail market, the more Chinese consumers that are buying here, the better. But I think with technology where it is, the old methodology that you have to have a middleman is getting broken down. And when players like Amazon and it's not coming to me, the Chinese versions of it, but Alibaba and all their chains come into play, you don't really need the middlemen as much. So over time, I think technology will replace a lot of this. So for these guys, they're quite early in the story. And when technology is coming through Asia and Australia, and trust me, everything when it comes to Australia, it's already gone everywhere else. So when it's coming through to Australia, that's already going through. So I would say it's a tough market to play, but in the shorter term, it's got every positive news or bingo word that you can look for. And so it'll play out quite well. So it's had a really good run. You made a decent profit. I'd probably taking some money off the table and see how they perform over the next year.
I mean, it does own some brands as well, like UGG, so the UGG boots, and some Health Essence, which is health supplements as well. Any thoughts around a business like this?
It screams of opportunism, in my opinion, trying to capitalise on this sort of clean, green Australian produce theme, Daegu markets, things like that. My big question mark is, what is their sustainable competitive advantage? They probably don't have one. The fact is, once they reach a certain profit level or the profit margins get to a certain point, if they are that profitable, you're going to see a lot of competitors quickly come in and replicate what they've been able to do. And when we're talking about things like Daegu markets and things like that, I think if we're sitting here in, say, 5 years talking about infant milk, it's very unlikely that those unconventional channels will still be open. Things will be going through the more formal channels for the transaction of those particular goods. So I would be operating this space with caution. It's obviously been marketed very well off the IPO. It's been much sought after. But a lot of it is down to the name and the area that it operates rather than any sort of long-term growth in the company, in my opinion.
Okay, so an interesting company, but both our panellists a little bit cautious on AU8 is the stock code there. We now have Brenda from Perth who sent in this email. Hi panel, any cheap and attractive small miners out there that I could add to my portfolio? Cheap and attractive. I want to know some cheap and attractive miners as well. Nathan?
Look, I'd actually, instead of miner, I'd look at an energy stock. I think oil price has surprised me and has surprised the whole market, and it's broken right past, and it looks like on technicals it could actually break higher through the recent up run as well. So, you could see decent move in oil prices. If you look at a lot of the oil stocks, most of them have started to run or had a decent run. One of the ones that's a laggard in that space is Karoon Gas. I would look at that asset play, because if you look at the energy space, whether you're looking at coal, whether you're looking at LNG, or you're looking at oil, all of them are doing quite well on a commodity price basis. So someone like Karoon Gas has the asset base. I think the interest will come to it, and I expect probably in the next 6 months there'll be a fair amount of M&A. We've already seen early stages of M&A in the energy space. I think that'll play out, and if that comes through, I think Karoon Gas is one of the ones that's a laggard in that sector. So I'd be a buyer of Karoon.
Okay, so interesting. Concentrating on the energy space, you believe that there's more upside in 2018. How about you, Michael?
Difficult, because I don't really focus that intensely on that space. One that we did get some clients into, and again in the energy space, was something like Santos. If the energy price still holds at this level and continues to move higher, even though Santos has had a very good run, I do feel as though you could see it continue to trade its way out of any troubles that it might have had looking back a couple of years now. The higher Australian dollar is a benefit for them as well, because a lot of their debt is denominated in US dollars. So at the moment they're in a bit of a sweet spot where they've got the Aussie dollar pushing back towards 80. Obviously the energy price and the oil price has pushed above 60. They've been able to get their costs down significantly, reduce their headcount, and they've even started to pick up their capital expenditure program again, which will allow them to potentially generate some growth into the future. So that's definitely one I think is worth keeping an eye on as a bit of a turnaround story, not too dissimilar from what we saw from Fortescue Metals going back a couple of years, and Whitehaven Coal a couple of years. They're in that sort of sweet spot at the moment where they're doing a lot right on the company level, but they're being backed up by the underlying commodity price as well.
Okay, so plenty of ideas there in the resource space. We do have a caller on the line, so let's go straight to Bill from Western Australia. Bill, thanks for calling in.
Thanks. Good evening, panel. Look,
Great.
I've been looking since about mid-December at investing in a what I call a dead stock called Invocare. Sorry about the pun. That's a dad joke, isn't it? But when I first started watching, it was up around the mid $16 mark, but it's now come back to about $15.80, $15.75.
Sure.
Given the I would say the popularity of funerals, I'm surprised at the drop that there's very little interest in that stock. Any ideas?
Sure. Looking at Invocare, it is a very interesting stock because I guess if you have a look at the business of funerals, people dying more would be, or an increase in the growth rate of deaths would be a positive for a company like this. And you have sort of seen that play out in the last 52 weeks. I'm not sure why, but more people have been dying. But also there's that story of growth into the US, which has been actually holding back the companies. Not only that, prepaid funerals, who would have known? This company is a fund manager as well because they take your money for your funeral, hopefully later on when you die, and they invest that money, so they manage money as well. But look, you think that a company like this would be pretty limited in their growth opportunities. They can cut costs, there's efficiencies there, but really, how are you going to grow your market significantly and easily without risk?
Yeah, look, you need a substantial health risk coming through the market. Look, it's a play on the demographic. That's pretty much it. It's a play on the demographic. It's I suppose a defensive asset base, and it's been run quite well. There is a consolidation play in that sector that's played out for a while. The thing that you've got to be aware of is there was a recent float in a similar kind of business. Quite a good business, has done well, and when that happens, generally for some weird reason, every relative stock that can be compared for valuation tends to do extremely well. So that happened, and Invocare did extremely well, and the multiples got expanded. And once the float was done, generally the support is not so much there, and the share prices come off a bit. So there was a funeral stock that actually got floated at a pretty decent multiple, and that's done well, and Invocare's a bit of pressure coming off. Now, you are buying this stock as a defensive stock. Right now, the market is risk on. They're buying growth, and Invocare is not the high growth story. So you're going to see a bit of weakness. So net for me, it's not the area I want to be right now. If you see substantial market risk coming and the market goes to risk off, then this stock will come back in fashion. So I wouldn't be buying it. I'll wait, keep an eye on it. I want to see a decent reduction in price. I want to see value come back to the stock, because at this point you're buying a very low growth business.
Okay. I mean, thinking about it a little bit more, and funerals are becoming bigger events. People are spending more in terms of funerals, and they've almost become an event. So I guess they've become a higher margin business as well. Looking at Invocare, though, I guess the main issue is growth versus valuation. I noticed UBS just recently downgrading it to a sell. Would you be a backer of Invocare here?
Look, it's a very high quality business. It's almost a monopoly, or certainly one of the major players by some way. They did try and expand overseas in recent years, but I think they came back with their tail between their legs. They've got the premium sort of locations, if you like, for cemeteries and funeral homes, etc. But often share prices move for all sorts of reasons, not just valuation. A lot of it comes to sentiment. I mean, we're asking why is it sort of pulled back now from 18 to 16, but really why did it go up in the first place from 14 to 18? There's no real sort of underlying reason. I was looking at this and I did notice that the premium that Invocare trades to its peers blew out significantly in the last sort of 12 months or so. It always trades at a premium to its peers in the healthcare space by about sort of 40 or 50%, given the certainty in earnings. We know that people are getting older, the greater proportion of the population is aging, more people are dying. So you can rely on earnings growth into the future to some extent. But I think the premium that it was trading to its peers blew out to the extent of sort of 75, 80%. And now it's just the case that people have caught on to it. UBS has released its note, and now it's just moderated a little bit, and the valuations come back to the field, probably closer to what fair value is. And to be honest with you, it probably still has a little bit further to fall if it does start to trade back on that historical premium that it has to its peers, as opposed to this elevated premium. So very good business, will continue to be a good business, but it will often fluctuate just depending on sentiment and technical factors. And it did have a very good trend there for a while, so people probably jumped on board the trend and just rode it. But now that bubble's been popped, or that trend's been popped, I shouldn't use the word bubble necessarily too freely, there's people now taking their profits and it's just falling away like that.
Okay, so some downgrades coming through from this business. Both our panellists liking the business. It's more an issue with valuation, and I guess you're buying into a company that is demographically leveraged. We'll be back with more after this short break. If you'd like to speak with our expert panel, our number is 1300 30 34 35, or you can email us at yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and you can also email in yourmoney@skynews.com.au. And we have Jock on the line from New South Wales. Jock, welcome to the show. How can we help you out tonight?
Thanks, Julia. Thanks for taking my call. Woolworths has had a bit of a run-up lately, and I'm wondering whether we should be taking some profits, whether it's a buy, hold or sell, and do you think it can compete with all these foreign grocery companies opening up in Australia?
Good question. Woolworths, WOW is the stock code there. It has been making some ground against its rival Coles, but of course competition firing up in this space. You've still got Aldi expanding and perhaps some other international players looking to move into the Australian market as well. So having a look at the staples area, Michael, what do you think of Woolies?
The problems with Woolworths, if you can call them problems, are well documented and well known. Basically, Coles and Woolworths had the highest margins in the developed world for so long. They were a duopoly, then all of a sudden Aldi and Costco to some extent came into the market and started to discount and put downward pressure on margins for the major players. If you go into an Aldi, they might stock sort of one brand of tomato sauce. If you go into Woolworths, they'll have 10 there, which gives consumers great choice and optionality. But the problem is they can't necessarily compete on price. And that's where you get the issue where they get forced to put downward pressure on margins. Woolworths has invested in lower prices, if you can, again, use those sort of words. And it's worked to some extent in that they've managed to retain and regain some market share from the likes of Coles. But the issue is that I don't think that this competitive pressures from international entrants is going to go away anytime soon. In many ways, Aldi is only just beginning, and it's just starting to ramp up now into states that it previously wasn't even involved with. So yes, Woolworths has had a renaissance of sorts, given that it is reclaiming some of the market share that it lost from Coles, but I still feel as though this has a long, long way to play out, and we'll be talking about this probably in 5-10 years' time. I
feel like we've been talking about at least the last 2 years, the competitive pressures in this space. Woolworths has been making a bit of a comeback, but you know, around $27.50, that's the top end of the range it's been trading at over the last year and a half.
It's quite expensive. It's more expensive than Wesfarmers, and Wesfarmers up to recent times actually were the better players. They've even gone into UK with Bunnings. Woolies for me is a turnaround story that's still turning around, but priced as if they're running at full throttle.
A good description.
Yeah, it's turning around, and it's going to turn around for a long time. I mean, you've got to look at the competitive space. As Michael said, they're investing in getting market share back. In other words, they're basically giving up margin to give you a lower price, which means that then Wesfarmers, i.e. Coles, will then turn around and say, I will give up some of my margin to give you a lower price, and then Woolies to then come back and say, I will give you even more margin. So it's basically a price war. Nobody wins out of that. Well, the consumer does. And so gradually you will see declining margins. That'll continue to play out. The Amazon story, everyone got overly excited, and then everyone thought that's fizzled out. Amazon is like an anaconda. It doesn't come and bite you. It basically puts itself everywhere and then just squeezes and squeezes, and it's a long-term kill. They're not there to make quick money. They don't care if they make a loss. They're there to dominate the market. So it'll be a slow burn. So they will accentuate the margin decline in the supermarket industry. So that's just in the actual supermarket. Then you look at the overall picture of what's happening to consumer spending. There's definitely a risk that consumer spending will decline over the next couple of years, which means there will be more pressure on consumers. So for me, the supermarket sector looks really tough. And you're buying in Woolworths, you're buying a story that the market has already paid a premium for the turnaround. So I think there's a lot of risk in Woolies. Everyone's paid up for the turnaround story in Metcash. I'd probably think Wesfarmers is probably the better story, but even they have issues, and I think just the sector, it's not worth it at this point.
Okay, so that was Woolies. We do have our next caller on the line, so let's go straight to Nick from Melbourne. Nick, welcome to the show. What is your question for our panel tonight?
Hi, I've got a question for two stocks that I've recently purchased. One of them is Netcom Wireless. I purchased it because full year 18 revenue is going to be more than market cap, and it's looking okay cash-wise. The other one is something I potentially want to hold long-term called Nanosonics. Revenue, I think, long-term will be quite good. And the third question, given that we're 10 years into a bull market, should I be looking at a bear ETF for the S&P 500?
Oh, you'd have to be pretty brave, but good questions coming through.
Not now, but maybe soon when things aren't as rosy as now.
Sure. So having a look at three areas, Netcom Wireless, NTC is the stock code there, Nanosonics, and given that we're probably about halfway, 10 years into a bull market, should you be looking at protection strategies or a bear ETF? Let's start off by looking at some of the easier questions. Let's go with Netcom Wireless first. Having a look at Netcom Wireless, any thoughts on this one? We've seen a bit of erosion of capital over the years. Is it going to make a comeback?
I remember looking at this one a few years ago and I haven't really looked at it since. It basically provides the infrastructure used for 3G and 4G technology. The telco space as a whole has been under immense pressure. I think this has sort of been caught up in that, but I stand corrected on Netcom. But I must admit, I'm not across the nitty-gritty of what the business is going through at this point.
Okay. So looking at Netcom Wireless, any thoughts?
Yeah, look, I mean, to put it bluntly, they make boxes, people stick it together, and it gives you a better internet connection. That's pretty much it. So they've done a really good job with the NBN. So then the big growth story is about what they potentially could do in the US. So they pretty much have a deal with AT&T, but we really don't know what that deal is. And given that AT&T is in the middle of a M&A period where the Trump administration has blocked, that's kind of been dragged along, and we're not getting much clarity. So for the Netcom Wireless, it's really a growth story about US, but that hasn't eventuated, and management has promised a number of times and haven't delivered. So the share price originally ran up, and I lost a bit of money on this as well, went up to, I think from memory, 365 to be exact. I think it got up that high from about 75 cents, and then it fell right back because management hasn't delivered. Now, if they do get the US story up and running and management delivers, this stock will probably double or triple from here. But the question is, they haven't. Do you go in, and how long does it take for the turnaround to come through? It's going to take a bit of time. So I'd probably say you're better off waiting for the turnaround and then jumping in. But around these levels, the markets to a certain extent have given up on that stock. So you're probably not a bad time to buy, but you've got to be patient, because it could happen in 6 months, it could happen in a year, it could happen in 18 months. So that's the problem. You don't really know.
Yeah, it looks like the share price is maybe looking at bottoming out here at around about $1.20. A year ago it was around about double that. But as you mentioned, the rollout in the US, the key, and they should see record revenues this year.
Oh, look, if it turns around, I mean, it'll shoot the lights out, but it just hasn't happened yet. So it's a waiting game.
The other stock is Nanosonics, a favourite of the market, but look, at one time it was around about the $3.60 mark. We've seen it pull back quite substantially, down at about $2.70 at the moment. Nanosonics looking at trophon and I guess ultrasound probes and the disinfection of them.
Actually, this is one that we had in our most recent monthly report. I've never sort of invested in it in the past, but sort of early December started to get clients into it because it started to come off the boil a little bit. It's one of these companies that's gone through a decade of research and development, and it's got their product to market, and they're starting to see the benefits of that start to come through now. It's gone from being a loss maker year after year to returning its first profit this year, I think, and you can expect that to continue to grow into the future. So it's an interesting healthcare play that is making that transition, and that's pretty much the reason that we like it. It's obviously something that can be used not only in Australia but all around the world, and that's where these markets are starting to open up for them.
Okay, I mean, they specialise in infection control, and Trophon's just one of the products. There's still new products to come. But I guess the big story is the US. They've seen a bit of weakness because GE, one of their partners, has been under, I guess, a bit of pressure, which is also an opportunity for Nanosonics.
Look, I jumped on this early. I was in, I think it's around 70 cents or something. And
I swear.
Please let me finish how bad this is. I sold probably around 90 cents to $1, thinking, well, this happened in about a month. And I thought, wow, I've done really well. There you go, great trade. And then about 3 weeks later, it was like $1.80, and then it just kept on going. The problem I thought was, I mean, it makes sense. They make these big boxes that you put in the hospital, and they clean things. I mean, it's not, huge. It's not, this takes time. And the problem with that is, for me, I thought it would take them a lot longer to go market to all these hospitals and get them to buy into it. But funnily enough, once they started getting a few sales, things happen very quickly. So it's like those stories where they say it's a short story that took 20 years to write. They took a long time to get the product, and then bang, everything happened very quickly. So they did really well. Now, will they get back to those kind of multiples that the market got excited? Probably not. But will it probably go higher from here? I probably think so. Good management, they've done the hard work, they've done the marketing pitch, it obviously works. You have some partner weakness, yes, that plays out, but eventually that kind of goes through. What they offer is actually quite economical for the hospital, so that's why they will continue to use them. Instead of buying new things, they can clean things very quickly. So in that context, I think it works well, but yeah, it's one I missed.
Okay, so the Germinator company, Nanosonics, would you be buying it back at these levels?
I have this psychological problem when I miss something that's run that hard. I try to block it out of my mind to feel better. So that's one thing I have blocked out.
It has come back a long way, and I suppose the risk characteristics have shifted significantly in the last sort of 6-12 months, and that's the sort of view that we take, that it could probably look to recover at least sort of half of the losses from its peak going back a couple of years or so. So yeah, it's one to keep an eye on, and it's a much more mature business now.
And I guess if you have a look at their new products, which is in the hospital disinfection space, it's a massive market.
Well, that's the advantage, putting my psychological problems aside. The big advantage is they've done one product which they've taken around and shown the hospitals how it can work. So when they go to the next product, it'll be a lot easier because they will get their foot in the door. So you would think that, once they've done it once, the likelihood of success in the second product and the third product and the fourth product will be a lot easier. So, look, if I had to bet my money, yeah, I would think that they would recover at least half their losses. So it's not a bad one, and they've already got a product that's making them money. So it's not like they need to come to you for cash. So you're probably not going to get diluted. So net, it's a good company, good management, and I would back them to recover. Apart from my own personal problems.
Okay, so two very interesting companies we've looked at, Netcom Wireless as well as Nanosonics. The last part of the question was regarding, how long this bull market has run and how much further it has to go, and whether you'd be looking at any protection at the moment and how you would be perhaps doing that, Michael.
Look, it's difficult because obviously you're standing in the way of a freight train, but in many ways you can slowly look to reduce your net long exposure by buying into something like this BEAR inverse fund, because obviously if the market falls, you'll be offsetting at least your losses on your other stocks partially. It's difficult to sort of call a top to this market. We've heard all the phrases like melt up, synchronized global growth. So it's very, very difficult at this point, in my opinion, to be putting something on like this. You can almost look to maybe put on options as well. That's a strategy that you could employ that can help maybe boost your income as well in the periods. So look, for me, I wouldn't be rushing to put this on. I'd be looking to maybe go to cash, in little bits of cash at a time. So maybe put, say, 5% of your portfolio in cash, then 10%, and that'll give you some flexibility, because although the markets might have a retracement, it mightn't be a huge crash like a GFC style event. It might be a bit more of a retracement, say 5, 10%, maybe 20% that takes it to a bear market. In that situation, I think probably cash is a bit more preferred as opposed to a bear fund, because you'll at least have the funds there to deploy, rather than making the psychological decision, I need to now exit my bear fund and now go fully long. It's a big step to make at once.
I mean, Nathan, it sounds really responsible looking at protection, but protection, there is a cost involved if you're wrong.
Sure.
So would you be looking at that now? Would you be doing it through a bear ETF, or would you be buying and put through the options market? Volatility's low, it's relatively cheap.
Look, credit to the caller. I mean, you want to be doing things that the market is not looking at, and that's how you make the big returns. Obviously, no one's looking at protecting themselves, because if you look at the VIX index in the US, it's at all-time lows.
And it's been that for so long.
So in the last 12 months, it's made more VIX numbers below 10 than it has in the last 50 years. So in that context, market is completely ignoring risk. That is a worry, but there are some macro reasons for that. And Michael's right. Right now, it feels like you're standing in front of a freight train, and there's only one outcome out of that. So you probably wouldn't buy into bear ETF right now, but I think that concept is solid. I would keep an eye on the market. I think if it runs at the same speed it's running now, probably in about 6 months, you'd want to look at this, because I think in the next year to 2 years, there will be an occasion where you will make big returns in the bear ETF. But right now it's probably not the one, simply because the US market still has to digest what the tax benefits are going to be, still has to digest how the reporting cycle will play out. So most of those things are going to be quite positive. And China is still quite accommodating, and BOJ and ECB are basically throwing out cash for nothing. So it's really hard to see it go wrong in the short term, but medium to long term, I think there's definitely risk in the market.
And I guess one of the most amazing things about the market is that you can be completely right and still lose money. So making money from a point of view is a difficult part. On that note, we'll be back with more after this short break. If you'd like to speak with our expert panel, give us a call on 1300 30 34 35, or you can email us, yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Australia's Business Channel.
Welcome back to the program. Joining me on the panel tonight, we have Nathan Simasundram from Blue Ocean Equities, and also Michael Wayne from Magellan Financial. And if you have a question you'd like answered, please give us a call. The number's 1300 30 34 35, or you can email yourmoney@skynews.com.au. And we now have Nancy on the line from Ryde. Nancy, welcome to the show. Great to hear from you. How can we help you out tonight?
Hi, panel. Yes, I'm asking about Australian Mines, which I bought a month ago, and AMP. I know a lot of people don't like it, but there's a turnaround story, and I don't know. What do you think?
Sure. So let's start off with Australian Mines and then look at AMP. Australian Mines, the shares have seen a bit of a surge in the new year as well as in the month of December. We're seeing it trading around about 13 cents at the moment. So AUZ is the stock code. Michael, any thoughts?
Unfortunately, Nancy, I don't have many thoughts on AUZ. I don't even know what commodity they produce or explore for, so it's best that I leave this one.
Okay, so looking at Australian Mines, I think recently they completed the 100% ownership of the Scone project, which is a nickel cobalt project, because cobalt is a byproduct of mining a lot of commodities, although it would be nice if you had a pure cobalt mine.
Yes.
What do you think, Nathan?
Look, at this point, I mean, I don't know a specific stock, but I've actually heard about that code. There's it's in the hot stocks category. People have been chasing these, but at this point the market is getting ridiculously excited with small cap resources. Anything that picks up any decent commodity, a decent sized asset, good quality, if it's near a decent transport infrastructure, these things go for a very long time. Where you are in the cycle right now, this is when market is overly exuberant about resources, and most of these stocks, if you've been in the right time and it looks like you bought at the right time and you've had the early run, I'd be sitting tight. I think it'll probably have a few months that it'll do quite well. I just say if it has a decent run, take some money off the table and then let the rest run. Because I think, at this point, nickel's doing quite well. Obviously, lithium, cobalt, all of those things are doing really well. Copper is one of the better performers. Even iron ore, which was struggling, has rebounded. So overall, I just can't seem to find any bad commodities. Everything is actually doing quite well with the weaker US dollar. So in that context, if you're in a resource stock, especially one of those small cap miners that are exploring, and they're on the run and the market is interested in it, you probably will see more upside.
Okay. The other one, AMP, a contrarian view here, saying, is it an opportunity? We already have seen a bounce back from the lows of about $4.80, so it's trading at about $5.20 now. Look, the highs of the year and the area it has a bit of trouble getting past is $5.40. So can we get there? Can we exceed $5.40? Market conditions are good, but it looks like a lot of financial planners and advisors are becoming independent. Nathan?
Yeah, look, AMP is a perennial dog. If you look at it over a long period of time, you just don't get much from it. It's a bit like NAB in the banking sector. If you looked at it the last 15 years, you're pretty much where you were if you ignore the dividends. So really, AMP is probably one of the underperformers in the insurance sector. Suncorp and IAG are much better quality. But in saying that, that whole sector has had a really good run because of the issues in the banking sector with Royal Commission and also the property bubble. So the insurance sector has outperformed the banks. I'd expect that to reverse a bit. And the Royal Commission is actually bad for the insurance sector because they'll be digging into the areas that's related to the banks, and that'll probably play into that. Because the biggest risk in the Royal Commission is not what we know, it's what we don't know and what comes out, and always something new comes out. The other thing to be aware of is AMP generally goes through what I call leadership cycles. So every 3-4 years they'll get a new CEO, the new CEO comes out and goes, oh, the world is coming to an end, and they'll cut and they'll resize and then they'll rebuild, and everyone gets excited, it's a turnaround, and then they'll pay up and then they'll find out it didn't really turn around and then it'll go down again. That's what's been the cycle for years. So you buy AMP when it's beaten up and nobody wants to talk about it. Very rarely in history has been a good idea to buy AMP when everyone's excited about it, and it's done quite well. So I probably wouldn't be going near AMP. I probably actually wouldn't touch much of the insurance stocks. I'd probably stay out of that. I'd probably look at in the financials. If I wanted a yield play, I'd probably look at the banks. They're not going to shoot the lights out, but they'll be steady. Or I'd look at global funds because they tend to give you the asset price and a decent return.
Okay, so it sounds like a no from Nathan on AMP. How about you, Michael?
Pretty much the same in my thoughts on AMP. Going back to 2000, I think it was amongst the top 10 biggest companies in Australia. They were the best positioned company to capitalise on the ageing population, the big boom in superannuation. But it just never really worked out for them. Their earnings have consistently fallen away, the dividend per share as well. They've had a number of sort of mergers and then divestments. Companies like Henderson Group was once upon a time part of AMP, obviously AXA, etc. But it just never quite seems to get all the aspects of that business moving in the one direction. They've got financial planning, they've got insurance, they've got funds management. They've had a lot of passive funds in the past, and a lot of active funds which are now moving into passive funds. There's been a lot of competition emerge in that active funds management space because of the emergence of ETFs and a lot of LICs as well, and that's put a lot of downward pressure on fees that they can charge for those passive funds. And I don't really see those pressures abating anytime soon. They have looked to divest a number of assets in recent times to try and sort of streamline that business. There's been talk of them moving into sort of Asia. That never really quite worked. They've come back. They've had a lot of management upheaval in the last sort of few years or so. So perhaps you're seeing a lot of the negativity sort of be priced into the company and some bargain hunters coming in. But if you take a medium to longer term view, I'd much rather be invested in those fund managers that have international exposure, given what we're seeing on an international scale, the growth and all those things.
And your favourite fund manager in that space?
Probably Janus Henderson Group, just given that it trades on the lowest multiple relative to its peers. That's a company that got really hit hard by the Brexit, a lot of fund outflows. What we've seen is they've had a merger with Janus Group from the United States. That gives them a nice distribution platform into the US. It reduces their reliance purely on the UK. And they're now starting to see fund flows turn positive after being negative for a while. Their fund performance has been very good over, say, 1, 3 and 5 years. They've also got a very diversified fund offering where it's not just equities. They've got fixed income, they've got property, alternative investments, and most of those funds have done very well as well. So relative to, say, a Platinum or a Magellan, they trade on less challenging multiples. So that's probably a preferred pick.
Okay, so lots of ideas there, and unfortunately our panellists both in agreement over AMP that that's in the too difficult basket for the time being. Let's go to our next caller. We have Roger on the line from Melbourne. Roger, welcome to the show. How can we help you out tonight?
Thanks for taking my call, Julia. I am
Pleasure.
interested in the healthcare sector, 2 stocks in particular, Cochlear,
Sure.
COH, and then MBF, Monash in vitro fertilization. And
Sure.
in general comments about the healthcare sector, what do you think about it? That's it. Thank you.
Sure, so having a look at the healthcare space and in particular focusing in on Cochlear as well as Monash IVF. Generally, when the market's running, healthcare tends to be more of a staple type of defensive sector and underperforms. But here in Australia, our healthcare sector is a little bit different in that it's very much growth focused. And in fact, it's been an outperformer over the last 52 weeks and since the global financial crisis as well. CSL, probably our top company in that healthcare space. If you had bought $10,000 worth of shares when it IPO'd, it'd be worth more than $1.5 million now. So can you fit Cochlear and Monash into that same story? I don't know. Nathan, what do you think of these companies?
Oh, look, Cochlear is a very good business. I mean, CSL is a phenomenally good business. They take your blood and then they sell you stuff from it. That's a great model. But look, it's a defensive business. I don't think Cochlear or MBF is that kind of business. Cochlear is a very well-run business. It's basically medical instruments, hearing, phenomenally good business. And I really liked what they did when their product had problems. They pulled it back and they took a hit for it a number of years ago and then they ran from it. It ran ahead of itself on multiples. It just blew out because everyone crammed into the same stocks. And Cochlear was one of those phenomenal performers and it's now come off. So it's quite interesting now. I think it's not a bad value here. Don't expect it to shoot the lights out, but I think it's not a bad value here, Cochlear. It is one I'd like, but I'm concerned about the overall sector because the multiples in the healthcare sector are quite stretched and they benefit from a lower currency. So the market was buying into healthcare assuming generally whenever you see a media article telling you that currency is going to 60 cents, usually they're completely wrong and the currency goes the other way, and that's happened again. So you saw the articles about it's going to fall to 60 cents and the currency bounced from the low 70s, now gone back to 78, and I think there's a real risk that it might go into the 80s with the strength in the commodities. If the US dollar keeps falling and the commodities stay strong, there is no reason why it wouldn't go higher. So if that happens, we're going to see more weakness in healthcare stocks because they're a currency play. So I think that's what you've got to be careful with. MBF, for me, all the IVF stocks have struggled. There's an overhang of regulatory risk sitting on top of them. There is the risk that they don't tell the customer how expensive it is to go through the whole process. It may look cheap for the one-off treatment, but the overall treatments, how many times you have to do that tells you the overall cost. So there could be a regulatory risk that they have to disclose all of these to the customers, and that might play into things. And also there are other players now entering the space where they're offering very cheap alternatives processes. So in that context, it is a bit too tough at this point. You kind of had similar risk in the aged care industry, and that's smashed those sectors back to very low multiples. So I'd probably be a bit wary.
So no and a no from Nathan. We're going to come back to hear Michael's opinion on both Cochlear as well as Monash IVF. We are going to take a short break, but we'll be back to answer more of your questions in just a moment. And don't forget, if you'd like to speak with us, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Sky News Business.
Welcome to the last segment of the show. Before the break, we were talking about the healthcare sector and especially Cochlear as well as Monash IVF. Now, Nathan wasn't a fan of these two stocks, but let's find out if Michael's interested in these two stocks and what he thinks of the healthcare space.
So healthcare, that was the best performing sector in the market in 2017, but it did have a torrid finish to 2016, so it sort of managed to recoup those losses. And there's a lot of good quality businesses in this space. I've been a big fan of it over the last couple of years and done very well off the likes of sort of your CSLs, Cochlears, Fisher & Paykel, ResMeds. But you need to be cautious going forward because we're talking about at the beginning of the show about rising bond yields, and what it tends to do is it tends to affect those higher PE, higher growth companies more than it does some of the others, because if you plug in a higher discount price in your discount cash flow model, it actually affects those with higher PEs more than it does those with low. So some of these companies need to be careful of. Cochlear, it's hard to sort of back against it because it is going through a good period in terms of the release of a new product. They've managed to overcome a lot of the issues that they've had in recent years. There was an issue with a lot of Chinese imitation products coming into the market, taking away their market share. Over time, people have realised that the genuine article's the preferred way of doing it, although you might have to pay slightly more. Cochlear also went through an issue where much of their sales growth and profit growth was coming from people upgrading existing ear implants as opposed to new people getting ear implants. But the technology advancements in this company have been amazing, so the Bluetooth connectivity and all that sort of stuff. So it's a very high quality business. The momentum in the share price is still very good as well. So they've got that earnings momentum, share price momentum, but it is difficult to jump in at these lofty valuations, but a very high quality company worth looking at on any sort of pullback. The other one was Monash IVF, and we're sort of talking about it in the break. There are a number of headwinds for this company or these style of businesses. A lot of competition is emerging in the space. A lot of cheaper products are coming, or cheap alternatives are coming in. There's issues with recruitment of staff as well for some of these sorts of companies. There's regulatory risk. They're selling hope in many cases, but who are we really to stand in the way of people having hope? So there's all these moral arguments that are starting to come up in that space. So overall, I do like the healthcare space a lot. However, I do feel as though they've had a very good run of late and there could be some rotation out of that space.
Okay, so that was the healthcare space. Time for our last caller of the night. We have Robin on the line from the Gold Coast. Robin, welcome to the show. What's your question for our panel tonight?
Yeah, thanks, Julia, for taking my call. I'm looking at buying Auckland Airport, so I just want to know what you think about it. And also, we do own Westfield, and what do you think about them being bought out? Thank you.
Sure. So having a look at Auckland International Airport, AIA is the stock code, as well as Westfield, and the takeover bid for the company. Let's start off with Auckland International Airport. Just like we're seeing here in Sydney, we are seeing international passengers flowing into New Zealand, and Auckland International has been doing quite well. I mean, we've been talking about the risks to Sydney airports in interest rates going up, but I guess Auckland airports, when you compare it to something like Sydney airports, it's not as developed. They don't have as many shops, retail, there's a possibility of property development. I don't think they've got a second airport that's being built out. But in terms of valuations, I mean, if you had to pick one, which would you pick, Nathan, Auckland or Sydney?
It'd be a tough one. I'd probably still stick to Sydney because of the diversified revenue models that they've already got. I think that's an upside for Auckland International Airport. It's a great asset. Don't get me wrong, I think it's a really good asset, but Sydney's a mature player and they dominate. I think the second airport is a no story for me. I think the Sydney airport by itself is a dominant airport and that'll maintain itself. But as you said, the macro story is probably against it at this point, so that's probably the only reason I'd be not inclined to buy it. But if you see the cycle turning and people are, if think the yields are going lower, interest rates are not going to go up as much, and then it'll be back on. If that's the case, Sydney airports and Transurban are obvious picks.
Okay, so don't like it while interest rates are going up, but if we see a reverse in the cycle, liking the infrastructure stocks, Auckland
Airport, it's got similar sort of macro reasons to buy it as Sydney airports. The tourism into New Zealand's been as strong as it has been in Australia. They've got more development opportunity, but it doesn't pay as big a dividend yield as Sydney airports. Its share price has been under a fair bit of pressure recently because their debt level's actually been increasing into an increasing interest rate environment. So for that reason, I'd probably prefer Sydney Airports over Auckland International if I had to pick, but I probably wouldn't pick any of them in this environment.
Okay, and Westfield, takeover offer on the table. What do you think of the takeover offer? What do you think of, shopping malls and the future of shopping malls, Michael?
Yeah, I mean, look, Westfield was having its worst year, I think, since 2011. It did manage to sort of bounce off its highs before this takeover offer came onto the table, but the pressure for these sorts of malls is undeniable. You've got the specialist retailers, your Zaras, etc. coming in. You've got threats from Amazon and whatnot as well in that retail space. So the writing is very much on the wall. A lot of retailers were struggling to meet rental increases. Once upon a time, many of these rental agreements were linked to inflation. Inflation's obviously been benign for a very long period of time. So it's been becoming more and more difficult for Westfield to boost their earnings. And for that reason, I think it's a good get out of jail card for many of those investments, many of the investors in Westfield.
Okay, any thoughts on shopping mall?
Look, when Loews are selling out, they're telling you something, and it's just like the Murdochs selling out of media. That tells you that sector is struggling and will struggle going forward. Those guys have been there a lot longer than we have, and if they're getting out, you shouldn't be there too.
And on that note, that's all we have time for today. Thanks so much to our guests for a supersized show. Michael Wayne from Medallion Financial and also Mathan Somasundram from Blue Ocean Equities. And of course to you, our viewers, for all your calls and your emails. If you did miss any of the show, want to listen again or catch up on the program, you can go to your favourite podcast platform and search for Sky News, Your Money, Your Call. Until next week, I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming.